Hi, and welcome to another weekly commentary. I'm Stuart Bergman. Russian President Vladimir Putin's large-scale invasion of Ukraine, the first major war in Europe since the end of the Second World War, is inflicting widespread casualties, resulting in a humanitarian catastrophe of epic proportions. As the impact of this crisis unfolds, our thoughts are with Ukrainians both here at home and abroad. The economic fallout of this crisis is having reverberations around the world. As we update our forecast, EDC Economics continues to monitor developments including the duration, intensity, and location of the conflict, the terms of any negotiated settlement, as well as ongoing sanctions and trade restrictions taken by both Russia and the West. Markets have remained relatively composed, a sign of the times perhaps, numbed by episode after episode of unprecedenteds. The VIX, the Chicago Board Options Exchange's famed fear gauge, isn't much different from where it was early last year and is certainly lower from where it was at this time 2 years ago. Haven assets, like gold, have been trading pretty much in the same range for much of the last 2 years. If anything, markets appear more preoccupied with the reaction of central bankers than with the actions of the generals. The conflict threatens to exacerbate ongoing supply chain disruptions, already a key driver of global inflationary trends. Russia is the world's largest exporter of grains and fertilizers and supplies about 40% of the world's palladium. 30% of titanium, is a key nickel producer, the third largest exporter of coal and steel, and fifth largest wood exporter. Few industries are going to escape the pricing pressures caused by shortages of these critical materials, from agriculture and autos to aerospace, clean tech, construction, and communication technologies. Ukraine is also a major exporter of agricultural products, metals, machinery, and auto parts, and, depending on the scale of the conflict, there's also a risk of disruption at neighboring ports on the Black Sea, including Romania and Bulgaria in the west, Georgia in the east, and Turkey to the south. Chief among commodity concerns these days is energy, with Russia producing roughly 10% of global oil supplies. In fact, on March 1st, Brent crude jumped above the $100 mark and hasn't looked back since. We expect energy prices to stay high for a few quarters, notwithstanding the release of strategic reserves thanks to currently low global spare capacity. Again, depending on the scale of the conflict, oil and gas from Central Asia shipped through Azerbaijan, Georgia, for delivery via the Black Sea could also be at risk. Critically for Europe, Russia supplies about 40% of European natural gas, much of which goes through Ukraine, which is also a transshipment point for oil, with approximately 250 barrels per day of crude destined for Europe. While we don't yet expect Russia to cut off supplies completely, any disruption in natural gas flows to Europe would be painful. As a result, we expect this to drive up short-term global inflation, with significant implications on Europe in particular. This will complicate an already difficult decision for the European Central Bank, which will now have to contend with additional inflationary pressures on the one hand and the impacts of weaker confidence, consumption, and growth on the other. In fact, a recent ECB scenario analysis estimates that a 10% shortage in gas could shave almost a full percent off the euro area economy. The impact would be most severe among the larger natural gas importers like Germany and Italy, and in industries most dependent on energy, like aluminum. This conundrum could well result in a decoupling of major central bank policies around the timing of interest rate liftoff. The US Federal Reserve, for its part, is expected to move ahead with interest rate increases as planned, albeit more cautiously than originally anticipated. The ECB will likely continue to focus on a downscaling of its asset purchases for now, making any interest rate moves dependent on the de-escalation of military tensions and associated impacts on economic activity. The bottom line? The crisis in Ukraine will further exacerbate inflation, pressuring energy and food costs, and erode the purchasing power of consumers and businesses around the world. At the same time, uncertainties will rattle confidence and disrupt economic activity. We expect this to lead to a break between European and US economic growth and monetary policy, a deviation that should also play out on the currency side as well. For more on this, keep an eye out for EDC Economics' upcoming Global Economic Outlook. Thanks for tuning in. Until next week.